I would now like to turn to liquidity and financial market conditions. Surplus liquidity has, as reflected in average daily absorptions under the LAF at rupees 1.7 lakh crore during April-May, was lower than 2.9 lakh crore rupees during the full year 22-23. The shrinkage in surplus liquidity during April-May was, among other things, due to maturing of the TLTROs, which we had extended, which we had given during COVID times. The seasonal expansion in currency in circulation and build-up of government cash balances during this period also moderated surplus liquidity. Since the third week of May, however, the decline in currency in circulation and pickup in government spending have expanded system liquidity. This has got further augmented due to the Reserve Bank's market operations and the deposit of rupees 2,000 bank notes in the banks. The prevalence of surplus liquidity amidst higher recourse to marginal standing facility MSF by some banks suggests skewed liquidity distribution within the banking system. To address this situation, the Reserve Bank conducted a 14-day variable rate auction, that is a VRR auction, amounting to rupees 50,000 crore as part of its main operation on May 19, 2023. Similar to such auctions conducted earlier in February and March this year. Reflecting swiftness in its liquidity action, the Reserve Bank conducted a 14-day variable rate reverse repo auction. The earlier one I referred to was variable rate repo auction. Now I am referring to variable rate reverse repo auction, which is VRRR. So, reflecting the swiftness in its liquidity action, the Reserve Bank conducted a 14-day variable rate reverse repo auction, that is a VRRR auction, of 2 lakh crore on June 2nd. And thereafter, we have gone on to conduct a 4-day VRRR auction of 1 lakh crore on June 5th, a 3-day VRRR auction of 75,000 crore day before, that is on June 6th, and a 2-day VRRR auction, a VRRR auction of 75,000 crore on June 7th. Now, this was done considering the overall build-up of surplus liquidity. The response to these auctions, these VRRR auctions, has been cautious in, as per our experience, that is these VRRR auctions which we conducted over a period of last 4 or 5 days. The response from the banks has been fairly cautious. Going forward, the Reserve Bank will remain nimble in its liquidity management while ensuring that adequate resources are available for the productive requirements of the economy. The Reserve Bank will also ensure the orderly completion of the government market borrowing program in the current year. The moderation in system liquidity, along with its skewed distribution, was reflected in firming up of money market rates even beyond the repo rate on a few occasions before they came down from May 18 to sub-repo rate levels. Long-term rates have, however, remained broadly stable. This has led to sharp compression of term spreads in the recent period. The relative stability of long-term yields augurs well for the economy and suggests effective anchoring of market-based long-term inflation expectations. I would now like to briefly talk about the external sector. In recent months, the trade deficit has narrowed on the back of sharper decline in imports vis-à-vis exports. India is making resolute strides to achieve the $1 trillion merchandise export target by 2030 by focusing on diversification of markets and products, leveraging free trade agreements, strengthening manufacturing capacity and competitiveness by participating in value chains, and through schemes such as the production-linked incentive across sectors. Service exports and remittances have provided valuable support to India's external sector viability. During 22-23, services exports grew faster at 27.9% than merchandise exports, which grew by 6.9%. The current account deficit, that is expected to have moderated further in Q4 22-23 and should remain eminently manageable even in 23-24, that even in the current year also. On the financing side, foreign portfolio investment, that is FPI flows, have seen significant turnaround this year since April, that is in 23-24, led by equity flows. The net FPI inflows stand at $8.4 billion during the current financial year up to 6th of June, as against net outflows in the preceding 2 years, and the net outflows in the preceding 2 years were $14.1 billion in 21-22 and $5.9 billion last year in 22-23. Net FDI flows to India were $28 billion in 22-23 compared to $38.6 billion in the previous year. Preliminary data for April 23 suggest that FDI flows have also improved. Net inflows under non-resident deposits, net resident inflows under non-resident deposits increased to $8 billion during 22-23 from $3.2 billion in the previous year. The Indian rupee has remained stable since January this year. Overall, India's external sector remains resilient as key indicators such as current account deficit to GDP, external debt to GDP, and international investment position, IIP to GDP, all these ratios continue to improve. Foreign exchange reserves stood at a comfortable level of $595.1 billion as on 2nd June this year. Inclusive of net forward assets, our foreign exchange reserves are well above $600 billion. I shall now announce certain additional measures. There are about 8 additional measures, and I think all of them are quite important, so I request your patience for some more time. The first announcement relates to borrowing in call and notice money markets by scheduled commercial banks. The extant regulatory guidelines prescribe prudential limits for outstanding borrowing in call and notice money markets for scheduled commercial banks. With a view to providing greater flexibility for managing their liquidity, it has been decided that scheduled commercial banks, excluding small finance banks, can set their own limits for borrowing in call and notice money markets within the prescribed prudential limits for interbank liabilities. Second announcement relates to widening the scope of framework for resolution of stressed assets. Compromise settlements is recognized as a resolution mechanism in respect of non-performing assets, that is under the prudential framework of the Reserve Bank, which is currently applicable to scheduled commercial banks and select NBFCs. It is proposed to issue comprehensive guidelines on comprehensive settlements and on technical write-offs, which will now be made applicable to all regulated entities, including the cooperative banks. Further, it is also proposed to rationalize the existing prudential norms on restructuring of borrower accounts affected by natural calamities. The next announcement relates to a default loss guarantee arrangement in digital banking, popularly what is known as the FLDG in digital banking. The Reserve Bank had issued the regulatory framework for digital lending in August-September last year. With a view to further promoting responsible innovation and prudent risk management, it has been decided to issue guidelines on default loss guarantee arrangements in digital lending. This will further facilitate orderly development of digital lending ecosystem and enhance credit penetration in the economy. The next announcement relates to priority sector lending targets for primary urban cooperative banks. The Reserve Bank has undertaken several initiatives in recent years to strengthen the urban cooperative bank sector, that is the UCB sector, as well as to deepen financial inclusion. Such initiatives include revision of the priority sector lending targets for UCBs in 2020. While revising the priority sector lending targets, a glide path up to March 2024 was provided for a non-disruptive transition to achieve the revised targets. While a number of UCBs, that is urban cooperative banks, have met the required milestones as on March 2023, a need has arisen to ease the implementation challenges faced by the other UCBs. It has therefore been decided to extend the time frame for achieving the targets by 2 more years, that is up to March 2026. Further, urban cooperative banks, UCBs, which have met the targets as on 31st March 2023, shall be suitably incentivized. The next announcement relates to rationalization of the licensing framework for authorized persons under Foreign Exchange Management Act, that is FEMA. The licensing framework for authorized persons issued under FEMA was last reviewed in March 2006. Keeping in view the developments, including progressive liberalization under FEMA over the last several years, and to effectively meet the emerging requirements of the rapidly growing Indian economy, it has been decided